Good morning, everybody. This is Granny's House Part 2. I made the Granny's House Part 1 video over a year ago. We're finally back, and now we're going to look deeper into how investing in real estate really works and why it's completely different than something like just buying stocks. In Part 1, we compared buying stocks to owning some real estate, buying some real estate. We did the whole, if you inherited Granny's house thing to kind of show whether or not she really did well with her investment over time, buying that house in the 1950s or whatever. What would have happened if she'd bought stocks instead, yada, yada, yada. At the end of the day, the two vehicles are kind of a wash. You get leverage with real estate. With stocks, you have a slightly higher annual rate of return, but there's no order of magnitude difference between the two. If you're just buying, holding, hoping, watching the appreciation go up, and essentially speculating on, market appreciation. In this video, we want to look at the fundamentals of investing in real estate and why it is a completely different ballgame than investing in stocks, and why investing in real estate does not mean buying your own home and watching it go up in value and doing really well. So let's dive in. Here's Granny's house. You inherited it. It's worth $500,000. The average annual rate of appreciation for real estate right now is, say, 5%. So in year one, the house is going to go up in value by $25,000. You will realize a 5% rate of return. Alternatively, if you had not inherited Granny's house, or if you inherited Granny's house and decided to refinance it, so that you were leveraging your investment. So you only hold a 20% stake in Granny's house. So you'd either refinance it, take out the $400,000, only keep $100,000 of equity in the house, or in the scenario where you did not inherit Granny's house, but we're just looking at how a real estate investment works, and you have $100,000 to invest, you could buy Granny's house leveraged. With that $100,000, you would take on a $400,000 mortgage. So on the right-hand side here, we see the value of the house, $500,000. The down payment is 20%. You have invested $100,000. The annual rate of appreciation is 5%. You are going to make $25,000 on the full value of the property in the first year. So that's 5% of $500,000. Again, $25,000. That means that on your $100,000 investment, your return on investment is 25%. Of course, in this scenario, you have taken on a bunch of debt. You owe $400,000. We can't just exactly ignore that. What if you had taken Granny's house? If you inherited Granny's house and considered it an investment, you could just simply sit on it and let it go up in value, as we talked about with the house that you live in, or as we did in Granny's House Part 1, where we just relied on the appreciation from market appreciation to give you returns. You could rent Granny's house out. So if you owned Granny's house outright, $500,000, and you rented it out for, say, $2,000 a month, you would make an additional $24,000 in annual rent. Of course, that $24,000 is taxable income. It's not a capital gain. You're going to have to pay income tax on it. We're going to say that for the sake of this simplified analysis, that your marginal income tax rate is 28%. You're going to pay $6,720 of income tax on the $24,000. So your after-tax income from the rent is $17,280. You have now made the $25,000 in appreciation in year one, plus $17,280 for a total gain in your net worth of $42,280. That rate of return is 8.45%. By renting out Granny's house, we have increased your ROI from 5% to 8.45. What about on the leveraged side? If you had bought Granny's house with $100,000 down and rented it out for the same $2,000 a month, you would have a mortgage of $400,000. Based on some assumptions, I actually don't even remember what assumptions I put into the model because I created this last year when I did Granny's House Part 1. I think I used 4% for the mortgage interest. It might have been 5%. This is a simplified analysis. There are a lot of factors in the real world that you have to tweak to get the numbers precise, but the order of magnitude is so much different than simply passively investing in stocks or sitting on the house that you bought as an investment. If you rent out the house having bought it leveraged with just $100,000 down, this is what it looks like. You will have mortgage interest of $15,696 in the first year. Your taxable income is therefore $24,000 minus that, which is $8,304. At your 28% marginal income tax rate, you only owe $2,325 in tax, as opposed to the $6,720 when you did not leverage the purchase. Your after-tax income is $5,979. Oh, it's not as much as the after-tax income when you owned the house outright. But your income plus the equity of $25,000 is $30,979. So sure, you made $12,000 less than you did by owning Granny's house outright. But your rate of return, remember, you only invested $100,000, not $500,000. Your rate of return is 30.98%. So this seems like a slam dunk. You can make 31% instead of 8.5% by leveraging the purchase. We've factored in the mortgage here. We've got the mortgage interest coming off of the income, and we are way ahead of the game. So how is it that people feel like they want to invest in real estate, take the plunge, buy an investment property, and then after a year or two think, I'm not making any money, I've got to get out? How can that possibly be? Well, let's take a look at the cash flow analysis and what happens in your bank account versus the property and how people get confused about whether or not they're making money. Okay, in the case where you own the property outright, your equity at the beginning is $500,000. Your appreciation in the first year is $25,000, and therefore at the end of the first year, the equity you have in the property is $525,000. You have gained $25,000 of equity that's held in the property. You have not refinanced. You have not taken the money out of the property. You don't have direct access to this $25,000, but you have made this money in your bank account when you own Granny's house outright, worth $500,000. In your bank account, what does your bank account look like? Well, at the beginning of the year, relative to just this property, you have no money. However, $24,000 in rental income comes into your bank account. Income tax goes out of your bank account. You have positive cash flow in your bank account, $17,280. Your bank account will go up in that first year by $17,280 if you just hold on to Granny's house and rent it out. That looks pretty good. Your investment return in total between the money gained in the property and the money gained in the bank is $42,280 for a rate of return of 8.45%. This is a breakdown of what we looked at on the first slide. It shows you how the money that you've made in that first year breaks down between the property and your bank account. In this scenario, a person who inherited Granny's house and rented it out looks at this and says, hey, this is great. My bank account's going up each year. Property's going up in value. I'm good. This is a great investment. How does this work with a leveraged property? Here is the property breakdown. At the beginning of the year, you have $100,000 of equity in the property. It goes up in value by $25,000. Also, you have a mortgage on the property. Well, what happens with that mortgage? You're not only paying the interest every month, you are also paying down the principal. So $9,552 of principal will get paid off over the course of the first year. So your equity in the property will be $134,552. Your property gain will be more than it was if you owned the property outright at the beginning, because the tenant who's paying the rent is paying down some principal for you. They are making an additional investment in real property on your behalf. It's the property you already own, but you don't completely own it. You only own one-fifth of it at the beginning. The tenant is going to help you buy the rest of it back in your bank account in the leveraged scenario. This is where the wannabe investor or the accidental investor becomes disillusioned after a couple of years. They thought that owning real estate would make them a tycoon. They were sure that they'd make all kinds of money and get rich really fast, but they're finding that their bank account is going down. It's got negative cash flow because at the beginning of the year, you start relative to, you might have other money in the bank, but relative to owning this property, you have $0 in the bank. Rental income comes in, 24 grand. Income tax gets paid. It's only 23, 25. But you also have to pay the mortgage. You have to pay the principal and the interest. You have to make that mortgage payment. The total mortgage payment is $25,248 over the course of the year, leaving you with negative cash flow of $3,573. You have lost money in your bank, but you've gained money in the property. We put those two things together and we see the result that we had on the first slide, which is a combined gain in your net worth of 31%. You are worth $130,979 at the end of the year, but in your bank account, you've gone down in money. So what you see here beyond the knee-jerk reaction of negative cash flow is that the mortgage has done a couple of different things for you in this investment. First off, the interest portion of the mortgage reduced the income tax that you owe on the rental income. And secondly, the principal portion of the mortgage is going into the property, not into your bank account. So in your bank account, it looks like you're losing money. But in total, you have made more money than you did in the case where you did not leverage the purchase. This shows you that the rate of return, even after you have rent coming in and a mortgage being paid and negative cash flow in your bank account, it shows you how you are making more money. You're increasing your wealth faster when you leverage the property than when you don't leverage the property. The real magic lies in the fact that you only invested $100,000 on the right-hand side of this page. If you inherited Granny's house worth $500,000 and you refinanced that house so that it only had $100,000 of equity in it in year one, you would be on the right-hand side of the page, but you would also have what? $400,000 to play with, which means you could do this 4 more times. You could go buy 4 more Granny's houses, and each one would look like this, numbers-wise, resulting in a total net gain in the first year of $154,895. That is a little bit better than you do by just hanging on to Granny's house or having bought stocks. You could have taken the $500,000, sold the house, put it all into stocks. Do you think in the first year you would have made $152,000 from that investment in stocks? Probably not. This is the true power of investing in real estate. Now, if you've thought about investing in real estate, if you've, I meet a lot of people who have gone to seminars or watched YouTube videos from some of the famous, real estate investing types, mostly coming out of the United States, but not just out of the United States. One of the phrases that you will hear a lot in real estate investing from seasoned investors who will advise you on how to do really well. One of the phrases you will hear is cash flow is king. You've really got to make sure your cash flow is positive when you invest in real estate or you are doomed. Well, we just went through a whole analysis here where your cash flow in your bank was negative, and yet you were gaining $150,000 a year. So how do we rationalize this cash flow is king and having negative cash flow is doom concept with the fact that we just saw that negative cash flow resulted in you making a whole whack ton of money? Let's walk through that. Cash flow is king. In the Granny's house scenario we looked at, you made a $30,979 gain by removing $3,573 from your bank account. So effectively, the question to ask yourself there is, could you afford to spend $300 a month to add $31,000 a year to your net worth? Well, people do, going back to Granny's house part 1, people do dollar cost averaging. People say, hey, I'm going to save $50 a week. I'm going to save $300 a month. I'm going to put it into a savings plan. Well, that's negative cash flow, folks. If you're contributing to a savings plan, that is negative cash flow. Same thing as here. you are contributing out of your bank account a little bit of money each month into this running of this rental property, this income property, this investment property, and you are massively increasing your net worth. Now, of course, if you don't have that cash flow to spend, it's not going to work for you. So you have to have the cash flow. $300 a month, there are many people who think about investing in real estate who could afford $300 a month to increase their wealth by $31,000 a year. Well, what about the 5 times scenario that we talked about? Go to 5 times, you're increasing your wealth by $150,000 a year, but of course, your cash flow in your bank is now going to be negative $1,500 a month. I mean, negative $1,500 a month, that's terrible. The investing gurus are going to scream at you, oh my God, you're burning $1,500 a month. You can't be negative cash flow like that. It's not sustainable. And I mean, they're right, it's not sustainable. It might not even be doable for a lot of people. Can you afford to take on an extra $1,500 a month payment? You know, many of us cannot. We can't spend another $1,500 a month. Although, mind you, if you were told that that is going to allow you to make $150,000 a year, might you figure out a way to do that? Maybe you wouldn't be able to figure out a way to do that. But here's the thing. Many of the variables in investing in real estate are variables. You can change the rate at which you're paying down the mortgage. You could change the amortization. You might be able to find a better interest rate. You might be able to have put more money into the property. Your rents might go up. Your costs might go up. There are a lot of variables that make this whole thing more complicated than what this little simplified scenario shows. But many of those things are levers within your control, and you can tweak things until the cash flow in your bank account is zero or positive, and perhaps the amount of money you're making each year or the amount you're increasing your net worth each year isn't quite as much. So maybe instead of $150,000 a year of gain, you're gaining $120,000 a year, but your cash flow is zero, let's say. You have to play with the numbers, and this is where investing in real estate is truly active investing. It's not simply buying something and hoping for it to go up in value. It's looking at the spreadsheets, putting everything in spreadsheets, looking at the fundamentals of the property, the rental market, everything else, interest rates, and tweaking things until you find the balance between cash flow and wealth gain that works for you. Some people could easily spend $1,500 a month. In fact, people who make a lot, who have a high net income, want to invest in real estate. One of the benefits they get is negative cash flow because it helps reduce their tax burden, or certainly doesn't add as much to their tax burden. You're going to find that if you start investing in real estate, even when you have slightly negative cash flow in your bank account once a month, at the end of the year, you're going to find, I owe more income tax. Why do I owe more income tax? The fact that you're gaining wealth doesn't go unnoticed. The principal pay down, the rental income that comes in and goes into the property and not into your bank account, is still income. You are going to be taxed on it. So even with negative cash flow in your bank, depending on where that breaking point is and what your tax rate is and everything else, you might owe some income tax at the end of the year. So this illustration is simplified, but the principles are accurate. We are talking about an order of magnitude better wealth gain than simply passively holding on to an asset. Cash flow is king. Cash flow is king to scale. If you want to scale investing in real estate, if you want to end up owning 6 apartment buildings and 4 bungalows and 13 townhouses, you are not going to be able to sustain negative cash flow for each one of those properties in your bank account. If you want to scale, then you will need break-even or positive cash flow. Only you can determine what is the right trade-off for you. But with real estate investing, when you understand how it works, you have all these different levers to play with. You're not just dumping your money into an asset, hoping for the best. That's it, folks. This is what Granny's House can teach us about the basics of everyday investing in real estate. I hope you enjoyed our little visit to Granny's House. I hope you found it helpful and interesting and that it made sense. If you have any comments, positive, negative, questions, drop them in the comment section below. I will respond to anything that you want to say within reason. And I will see you in the next video.